The S&P 500 edged higher to kick off this week, continuing its climb despite growing signs of caution beneath the surface, obviously with how we started following the Moody's downgrade over the weekend. But for the third straight session, defensive sectors like staples, utilities, and healthcare led the way, with cyclical and growth areas lagging behind. This quiet rotation is sending a message. Investors are staying in, obviously, and we're not breaking down. We're still up like, what, five days in a row and almost 6 today. But everybody's getting more defensive. In today's market outlook, we'll dig into the shift in the sector leadership, what it means for market breadth and momentum, and how it's shaping the technical outlook. Plus, I'll walk you through a new bearish trade idea, long put vertical spread on Hershey's, as this defensive heavyweight shows signs of breaking of technical weakness despite the sector's recent strength. So let's break down the charts, the macro backdrop, and what to watch next. So let's go ahead and get started. Today is Monday, May the 19th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. You can sign up for our daily Market Outlook email here with this form. Just click on that button after you fill this out. Come down to the bottom. This is where you can watch the video, of course. Come down to the bottom. You can see this kind of a written summary of what happened today. If you come to the bottom, click this heart. It opens up this tab. You can hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. You can hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we finished higher again today, 6 straight days. So even after the gap down to the downside, following the Moody's debt downgrade, we still finished 0.09% higher, 5 points higher in the S&P. We got that cluster pre-expiration, and so far the momentum line dropped simply because of, again, a little bit smaller on the range. Again, relative to the average, right? Relative to 72 points, relative to the 104 point range that we've had. So helping to bring the momentum line down, we also had gap down. That also helps it. Doesn't help it stay up higher. So we finished with a cluster on Friday. We did not finish with a cluster today, though we did have the near-term line staying extremely high. I mean, the intermediate line's at the 99th percentile. Like, it hasn't been 99th percentile this whole entire time. The closest it got here was 97.8, and over here we got up to 98.4. So this is the only time in the past year that we've been at the 99th percentile or higher. So a really strong move there on the S&P. If you take a look at the NASDAQ, we did not have a cluster on Friday, but we did get a cluster today. So nice move higher on the momentum line, the near-term line maintaining its position in the reversal zone, a little bit higher than Friday, being above the 90th percentile, so sitting at extreme levels there. So in the market sentiment line rising, and now outside of bearish territory. So good sign there as we are more than 10% up above the 30-day moving average. That 30-day moving average is going to start rising really rapidly here. Take a look at the Dow Jones Industrial Average. It did get a cluster on Friday, did not today. The momentum line dropping down pretty significantly there. And then you can see the near-term line making its way even higher than what it was on Friday. On Friday it was above 80. Now it's up to the 97th percentile with the intermediate line itself sitting there above the 96th. Finally, if you take a look at the Russell 2000, again, not as bullish, and we stopped just sort of a cluster on Friday as the near-term line finished at the 79th percentile. The other two above 96, so just barely short of a cluster. And then, of course, your momentum line dropping again. Mainly, I think for the most part, the momentum line dropping on most of these indexes because of the gap to the downside. And the Russell did finish down, so unlike the S&P, which was up every day last week, the Russell was not up every day last week. It was up. It was down Wednesday and then down again today, post expiration. So, but it is, again, significantly above the 30-day moving average here at the 88th percentile. So not quite in the top decile, so we can get a green dot, but still extremely high. And you can, again, we're getting a new bullish near-term peak after a pullback down here. Really wasn't much of a pullback, but it was enough to get the near-term line down below the chart's midpoint. And this, we never did get that pullback here on the S&P. So the last pullback, near-term pullback we had was at the beginning of the month, and now we've had a nice near-term rally up to the upside. So two really strong near-term rallies back to back. You can see its market sentiment line is also rising out of bearish territory. Let's take a look now at the weekly chart and see what the S&P is showing there. We can see the golden cross, so the 10-week exponential moving average has crossed above the 40-week exponential moving average. So that's a good sign for the markets. You can see the size of the candle has gotten, it's still pretty darn high as it is, but you also see that it's smaller than the average. So the 3-week average, the last three periods, the current period is smaller than the 3-period average, and that's why it's slightly smaller. That's why you have the green line crossing below the purple line, which is the 3-period average there. So slight weakness there, but nothing too major. As you can see, we're close to a higher high. In fact, we might see 59.58, 59.60. Yeah, so we do have a higher high. And we have obviously have a higher close, Hakunashi close. There's no lower shadow, so no signs of transition or signs that will be at a transition next week at all. I mean, the close, Hakunashi close at 59.32. We're trading above the current Hakunashi close at 59.63. So still maintaining a very strong weekly candle there. If I take a look at the 3 green arrows, of course, we've had 3 green arrows for a very long time on a lot of these indexes, on all the indexes. If you take a look at the 2-line version of this, you can see we're well above the 200-day moving average. The MACD itself is still above 2%. The PPO, which is the normalized MACD, is well above is easily above the 2% mark. In fact, the average itself is above 1.5%. That's not very common for because that's a 9-day average. You can see it's not very common for it to get above the 1.5% mark. If I were to change this, the last time it was above 1.5%, the orange line was August of 2022, and then before that, this June of 2020 period coming off of the COVID low. So significant move higher on both of these lines, the MACD and its average, showing just how strong of a move that we've had here. If I take a look at some of these other oscillators like the DMI, again, we are above 30. We're not going parabolic, which is, looks like we're going parabolic, but the DMI does not suggest that we're going parabolic. The positive line's above 30, negative line's above 20, so it is trending. But you notice that the ADX is barely crossed above 20. So I mean, but we are way above the moving average, and your ADX is barely crossing above 20, which is very, very uncommon. If you take a look at the RSI and the CCI, we are flirting with 70 on the RSI. This can continue to push over here to today. So that's still green. And then you can see the weekly CCI is just on the cusp of crossing above positive 100. So if it's going to continue to move here this week to the upside, then there's a good chance we can get to 100. And then that would turn this green, right? Now we can start drawing this green as soon as it does cross above that 100 level, but not quite there yet. We'll see. It did get over here almost above 100 as well and stopped short briefly at the end of 2022. Of course, in August of 2022, we actually did get above 100 before working our way back down below minus 100 for a period of time. So even that can happen. But we are clearly above zero and working our way up to very positive levels on the CCI. And then if I look at the Ichimoku cloud, we still have a very mature trend. Again, one of the fastest changes from a mature bearish trend to a mature bullish trend that I've seen. Again, like I'm sure there's probably some other instances, but I still haven't found one that's faster than what we just saw. In the course of just a few weeks, we're clearly above the cloud, hence the strong momentum. The rate of change is extremely bullish, very, very bullish. You can see the cloud is very green. We're not, we'll see where we are when we get there, but assuming, considering how high we are and how mature the trend is, very good chance that by the time it turns green, we get there. Keep in mind that if you notice there in August of 2022, it also turned green over here. The cloud turned green on this big bullish breakout. We were well above the cloud. We had a strong rate of change. The cloud turned green. By the time we got to the green cloud, we were sitting in it, sitting right on it, and we lost our mature bullish trend and it turned bearish. So this doesn't necessarily, it's very good, but it doesn't necessarily mean that it's like this is all over, that we're kind of done with this. You can see the weekly, we're above the cloud. The rate of change, the 26-week rate of change is only slightly negative now. And you can see that, we had a bearish trend and it's gone. Like now it's gone and we're sitting at zero on both the trend quality and trend noise balance there on the weekly chart. And we have the pink shading and we're already above the cloud well before we even get to the pink shading. So that's a good sign for the markets there to avoid more of a significant correction that would border on, again, bear market levels. Let's take a look at the Bollinger Bands and the Keltner channels. You can see we are, the bandwidth is still extremely high, though it's coming down a little bit. We are in the upper quartile of the bandwidth, still up above the upper Keltner channel. In fact, we opened above the upper Keltner channel. So as bearish as we open, this kind of shows how strongly bullish we are. As bearish as the open was, it still stayed above the upper Keltner channel. And we're finishing there again with the extremely bullish momentum that's waning just a little bit, but not too significant. If I take a look at the intraday chart, we did get a new high today. Very small range, just like we saw the last week's range was very small. This is going to start moving up. The size of the channel is going to start dropping very rapidly because the low point here today is here, and then tomorrow it's going to be here, and then Wednesday it's going to be here, and then Thursday and Friday. So this would be today, Tuesday, Monday, today, Tuesday, Wednesday, Thursday, Friday, and then by next Tuesday it will stay here it's going to stay here for a few days, and then by next Wednesday it's going to jump up to here. So it's really good, and again, unless we get significant new highs, which we really didn't get today, then we're going to get a real significant drop in the size of this channel width, considering how big it is already. I showed you the range was smaller than average at 7.5 points. The volume still smaller than average as well at 68 million. So when you put those numbers in context, again, remember we are easily below the 2% mark and working our way to trying to get below the 1.5% mark on the ATR. So significant drop there. That's a very, very good. And then we take a look at the VIX. The VIX is still below 20, very good sign. It's below 90%, very good sign. The only thing that's not a good sign, and still below the 200-day moving average. The VIX itself being below its 200-day moving average, which is also a very good sign. So all three of those things really working out. The only thing that's not is the fourth, which is the VVIX, is actually above 90. So instead of breaking below 90, it's above 90. If I take a look at this here, and then let's get rid of this here. You can see that we are, we're bouncing up. Like we tried to get below, we finished one day below 90, bounced right back up above it, and now we're moving back up towards 100. And again, because of that, your correlation between the VIX and the VVIX has dropped back below the 75% mark again, because the VIX is dropping, but the VVIX is rising, and that's negative correlation, less positive correlations, considering how positively correlated it normally is. When it does drop to levels that are not nearly as strong, it tends to precede jumps in volatility, because the VVIX typically goes up first before volatility does. So that's something to keep an eye on. It's the second time that we've had a drop below the 75% mark on the positive correlation between the VIX and the VVIX. All right, now let's take a look at what's driving this price action. You can see the rebound just in the last 3 months. So again, this is the day that it started. Actually, the 19th was the last up day. The 20th was the first down day of this decline. So the 3-month period now pretty much extends back to when this all started. This whole decline started. You can see the S&P is now within 3%, less than 3% from its all-time high. Developed markets are doing really well. Developed markets are up almost 7% from that date. Emerging markets are up almost 4%. Gold is still up 10%. Despite the fact that commodities are actually down, that commodities are down. In fact, commodities have the worst performance besides small cap stocks, and that's kind of the interesting pattern that we're seeing here. As great of a return that we've had to get back to this in the S&P 500, the Qs are just dominating the Russell 2000. In fact, the Qs never did gain during the period of this decline, during that entire decline there. By the time it was all said and done, the Qs and the Russell 2000 actually finished together at the lowest point, and now of course the Qs are up higher. So you never really had a jump in outperformance from the small cap index during the pullback, which is what you typically see. We saw that in 2022. Didn't see it so much in 2020 because the COVID and the economic shutdown impacted small cap stocks. But look at 2022 was a significant decline in the Qs relative to IWM. And that's typical, and this index is typically positively correlated with the S&P 500. It's now returning back to a positive correlation with the S&P 500. So you think, and that's even like the breadth is not bad. Like look at the number of stocks above the 50-day moving average is now up to almost 400, well into bullish territory. The number of stocks above the 200-day moving average is well above the 250 mark. Not quite above 300 yet, but still, I mean, way at bullish levels. The ratio here is way down below 0.7. We haven't been down below 0.7. Again, this is what happens when it first drops. When you've been on this correction mode and you first drop, you can see we didn't get below 0.7 in March. We did get below 0.7, however. In fact, we got all the way below 0.5 in August. And then we started to move up higher here as the market went down and pop back up again. So, but typically when you start these big bullish moves, it starts with a big drop in this level, because the number of stocks above the 50-day moving average, these stocks jump up first above their 50 before they jump up above their 200. And this is a pretty broad move. Like I said, well above, 400 is 80%. And you can see we don't typically stay above 400, nor do we get above 450 very often. But we're well above 300, which is bullish levels. To get above 300 and staying above 300 is very, very good. In fact, the number of new highs have started to jump up because we're getting close to the new highs, to the all-time highs. We're at 75 here. The number of the net new highs and lows is still flirting around the 100 level, but they're starting to slowly move higher, right? If you look at just the past year, this the 1 year alone, you can see like we're above them. The moving average is rising. It's slowly creeping higher, and that's what happens when you're bullish, right? You start to get closer to the new highs, and you'll start to get more stocks getting up to new highs. So very, very good sign. The number of stocks about that are new lows, forming new lows, is very low. Like we just don't get any stocks forming new lows, which is good, right? That's a very, very good sign. A very good sign for breadth in the markets. In fact, the McClellan oscillator has been slowly moving its way. It's back above 500. We're still above 35 on the pot. This is a very good, strong breadth move. That's a very solid move to start a new solid trend. Not only start a new intermediate trend, but what we're looking at is starting a new market sentiment trend, right? With market sentiment out of bearish territory now, we're on this intermediate run. We've solidified it with this cluster. We've got two really good near-term rallies going on. We're well above the 30-day moving average. You know, that breadth has really helped solidify that. You know, and even though, you know, despite the fact that the Russell 2000 is not quite there because it continues to lag so significantly. Let me take a look at the here. Let's pull up the Qs again relative to IWM. Again, IWM lagging so much relative, and you see that, right? You see, but the big ratios you really want to see is, you know, like technology relative to either utilities or energy, either one of them, very strongly positively correlated. And you can see we made a run above the 200-day moving average. Now that hasn't held up. In fact, if you notice the last 3 sessions here, here if I were to zoom out now on, or take a look at the sector comparison chart over the last 3 sessions, you notice we haven't been as strongly bullish. So let's go to May and we'll come 1, 2, 3. So this is the last 3 days. You can see like your safety trades are your biggest winners, like 3.5%, 4%. When technology and discretionary are lagging the broader market as a whole. So, you know, we're getting a lot of moves higher now in breadth because of what we're seeing here. Like initially we had moved up so much in technology and discretionary, and you know, those were the big winners. Industrials too, you know, they're still the big winners. I mean, XLK is up 30%, and you can see a lot of these safety trades were just such significant laggers. But now, like, they've been rising. The last 3 days, they've been rising, and those other areas are starting to show some small signs that we might be kind of hitting some resistance here. The other one, again, is looking at the discretionary versus staples, which went parabolic here and has since come pretty significantly down. Now, it hasn't broken any of these moving averages, but is well off of its highs. And if you take a look just in general of growth versus value here, let's try this again. So, which is also strongly positively correlated. You can see, you know, it has peaked growth relative to value, and it appears that we might be kind of hitting some momentum. So it's probably a good sign right now, and it's actually a good sign from a breadth standpoint that some of these other areas lead the market higher. Now, you know, it's a good sign. Ultimately, like right now, it's a sign that we are just running out of gas. You know, we've been so bullish on these areas. We want these areas to be bullish, right? They're the ones that we want to lead the markets higher. We want to see technology do really well here. We want to see the rotation, like they get the relative strength, which is not above 100 yet, but we want, that's on energy here. Let's pull up technology. It actually is above on technology. You can see the momentum, like it, I mean, the relative strength got all the way up to 103. Like it hasn't been above 103 for quite a while. You have to go all the way back to over here in 2023, in June of 2023, and you can see from that point, even though it continued to rally for multiple months later, we were just flat sideways because we peaked in relative strength and then rolled back over as we lost momentum, well up above its 50-day average, and kind of showing the same right now. But that's a very, very high momentum that we're starting to show some cracks. And if I were to take a look at the weekly version of this, which has been, that's, it kind of led us into the correction. You see we're up to the 50-week moving average. We're well above the 8 and 17. The 8's crossing the 17. But your relative strength is still very negative. And your momentum is just barely turning positive. So in other words, when you look at the relative rotation graph, you can see on the weekly chart, all these other areas that are not correlated to risk appetite, when they outperform, are pulling down to the left. And you can see technology and discretionary are starting to slowly move up to the right, but they're still very negative there. So we need to see a lot more. We need to see this daily version. We need to see that momentum pick back up before relative strength drops down. You can see that happens right here. It happened here. It picked back up before the relative strength went back to below 100. And then this time it did. We went sideways for quite a while, and then we had a really big, significant move higher before we started to have some underperformance or some volatility. So needless to say, this is a very, very good move. we're significantly up above the moving average there. When I take a look at XLK here relative to SPY, again, you can see just how significant this is, how high the PPO is. Here, let me zoom out so we can get some perspective on these levels. How high the PPO is, very, very high PPO again, similar to the move we saw in 2023. The correlation very strongly positive, the RSI at strong levels, the CCI at strong levels, the ADX not so much. In fact, the ADX now is kind of flattening out as we lose some momentum. So a very strong move to get us to this point, but now it appears we might be starting to kind of exhale a little bit. But shoot, if this is what an exhale looks like, and we just pass the baton over to these areas, which are not positively correlated to the markets when they outperform, but if they're moving up, and at least they're moving up enough to bring the S&P up 1%, even though it's not outperforming, right? Because if I look at the asset class comparison for the same time frame for the last 3 periods, where these safety trades have been outperforming but moving higher, with everything moving higher. I mean, the markets are up, but gold is up more, real estate's up way more, and developed markets, you can see, are outperforming, with emerging markets flat, the dollar down, and commodities really struggling. And that's, those are the kind of the areas to kind of watch from a broader market standpoint. Is the dollar going to push down and drop back down again? Which was on this bearish trend for most of this correction that we've been in. Is it going to drop back down again and to sell the U.S. Kind of market? Is the 10-year yield going to continue higher? See, it was actually down during a lot of that correction, but now it's moving higher and it's trying to get above 4. And it started the day above 4.5% before moving lower, but you can see the short-term sentiment starting to bounce. So we're going to start to get higher yields here. What kind of impact will that have? And then commodities, you can see it had made a bear tag looking like it would rebound, but then you have this bearish near-term cross, and we pull back to the moving average, and we'll see if we can rebound higher. Like, we can take higher yields as long as commodities are moving higher, but if commodities aren't moving higher, if yields are moving higher but commodities aren't, then we have a problem. Because again, that's more of and yields need to be going higher because economic growth is fueling that rise. And again, I've told you before, and this is a very common thing we talk about in these videos, but the best case scenario for stocks, the best case scenario for equities, is for the Fed not to cut rates this year. We do not want them to cut rates. We wanted them to only do a mid-cycle adjustment at the end of last year. We want them to have rates on the table, but continually to take them off the table. They've been taking them off. You can see now it's almost completely taken off for June, and that's good. Now we need, the next step would be they're on the table for September, but as we get closer to September, you can see we want to take them off the table and push it out to December. And the more we do that, the more we push, keep them on the table, take them off, push it out to the next time, the more bullish the markets. The markets love that, right? And ultimately that has an impact on the spread. And what really we want to see is, we don't want necessarily to see the spread go up. We want it to see it kind of peak and gradually move its way back down here towards zero as, again, those long-term, short-term rates start to, peak and stop going down, right? They've been, these short-term rates have been going down, but they appear to be kind of bouncing back up again. So the more that these can rally and the 10-year yield kind of stops going up, then that will put some pressure on this back to the downside, and that's perfectly what we want, right? That is, the stock markets love a falling yield spread. They love an inverted yield spread. So that, as we roll over and start to work our way down there, that's what we want to see, and that will happen as long as the Fed keeps just pushing off rate cuts, because we don't need it, right? That's the scenario. That's the ideal scenario, that we don't need to have the cuts, that the economy is rolling along just fine without them. And the more that that's the case, the more the markets are able to justify the very, very strong valuations. As I've talked about before, the valuations remain very, very strong for the market. So we're not setting ourselves up for, a huge, I mean, we're above 35, we're above 36 now. Like, we're not setting ourselves up for a market sentiment run that's going to take 2 years and go up 70%. Like the last one, like when we came off the 2022 low point here, where, at least we got to the low 20s. We didn't do that here. We got all the way down to 34 during this correction. So we're not going to set ourselves up for a big run. But as long, if we can go up for as long as we can possibly go up, great, right? Before ultimately we do get the type of correction, not like what we just saw, but one more like 2022 or worse, where we actually do get more of a reset in valuations than where we're currently at right now. That brings us to our trade idea of the day, and the trade today is going to be on Hershey's. Hershey's, unlike the rest of the market, a lot of these staple companies really struggling. Hershey's especially, you can see it's been in the decline for most of the past year. It had a little bit of a rebound, sideways action during this correction. But now it's starting to rotate its way back down. Dark pink shading and a red line, intermediate line dropping back below market sentiment, back into bearish territory. You're 5% below the moving average. The short-term sentiment's bearish. When you look at the weekly chart, we've been in this death cross for more than a year, about a year and a half now. We're back to after a transition. Candles, multiple weekly transition candles. We got another red arrow last week, got a bearish candle this week. PPO's falling again. You can see this pretty decent size of a bearish candle there. When you look at the 3 green arrow chart, we obviously have 3 red arrows again for the last 5 days. 3 red arrows, some pretty decent volume the last couple of days on the breakdown. When you look at the 2-line version of this chart, you see the MACD and stochastics breaking down the bearish levels, 8 and 17 day crossing below the 30. Everything pointed lower. We're below the value area, breaking back down below the value area the past year. So pretty bearish from that perspective. If I were to take a look at some of these other oscillators like the DMI, you can see we're above 25 on the negative indicator, well below 20 on the positive. The ADX has been rising from very low levels, so we've been in this kind of really trend ready state for quite some time, and it looks like we're starting to break out. The RSI below 40, the CCI well below minus 100. If I look at the Ichimoku cloud, you can see we're below the cloud. The rate of change is negative again. We're below both the green and the blue lines. The trend is moving towards developing a new bearish trend. If I look at the Bollinger Bands and the Keltner channels, you can see we're below the lower band today for the second straight day. The band width has been extremely low during this sideways action, way inside the Keltner channels, but now we're probably maybe one more day away from breaking out of the Keltner. We're below the lower band. We're pushing down against the lower Keltner channel. So pretty bearish breakout patterns there. So what I decided to do was to do a long vertical spread to the downside. So selling the 26 delta, buying the 34. We ended up, again, position sizing like we always do for the $500, but getting about a 2.5 to 1 reward to risk ratio with a little bit of flexibility for timing on the entry of the trade. And that's our trade idea for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join us on marketscholars.com for free, follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.